I'm Alice Lee, Executive Director, Center for Technology Licensing, Cornell's Tech Transfer Program. And I welcome you and thank you for attending third annual Ignite Connect event. There will be 16 teams today pitching for investment and for partnerships. Oops. So as we all know, universities generate breakthrough technologies, but they tend to be at the very early stage. And our GAP funding program, the Ignite Lab to Market and Enterprise Innovation Catalyst Fund, both a GAP funding series that help these projects pass through the valley of death to go to the next steps. The Ignite funding has three main programs and innovation acceleration to advance the very early projects through the lab, the fellow program for new ventures, and also startup project to help new startup to raise funding for the next step. The Enterprise Innovation Catalyst Fund was launched last year at Weill Cornell Medicine, building on the success of Daedalus Fund at the college for a number of years and trying to advance medical technologies in multiple asset pillars. The project presented today have been de-risked, leveraging these fundings and program support who are ready to go to the next step. I want to highlight the first Ignite report, which was just released last week, and to cover the activities from 2021 to 2025. A few metrics highlight projects have been supported by Ignite funding has raised more than $230 million in follow-on funding, a 41-to-2 ratio, and 38 new license and options were executed for technology commercialization, and 32 startup companies has secured significant funding for growth after they received the Ignite funding. So please check out this program with the report. Another thing I want to highlight is our Cornell overall innovation ecosystem. The Ignite funding has been managed by CTL, working very closely with our incubators and accelerators and education program. Together, we're building this innovation ecosystem to advance our innovation, commercialization, and new ventures. Before I start the spotlight, and I want to thank our Ignite external committee members for industry expert and investors. And it's through them, their guidance and support, we design these programs and also select the project for success. So thank you for your support and also welcome others to engage with us in various capacities. A spotlight speaker, Dr. Alexandra Cantley, right? Who has been serving on the Ignite committee for the past 5 years. Welcome, Alexandra.
Thank you so much.
I would like Alexandra to give a little background of herself first. Yeah.
Great. Well, I'm really looking forward to the conversation today and also to hear the pitches later. And I just want to start by saying that over the last several years being involved in the Ignite Fellowship program, it's just been really great to see how thoughtful Cornell is in thinking about different unique ways to support entrepreneurialism within the institution. So that's just been really exciting as an investor that frequently looks at technologies coming out of universities. So just a bit on my background. So I live in New York. I am a scientist by training. So I started at Polaris about 7 years ago, where I focus on our early stage biotech investing. But I was actually trained as a scientist. Before coming over to the investing side of things, I did a PhD in chemical biology at Harvard, was interested in industry. So I immediately went right out of grad school to spend some time at Vertex Pharmaceuticals, where I worked in R&D, and actually had the pleasure of being integrated into sort of, the alpha-1 antitrypsin deficiency program. So a real program that was moving into the clinic. It was a great experience. And then I was interested in, what it would be like to work at a startup. So I ended up kind of serendipitously getting the opportunity to be an employee one at a company that was being built in New York, based on some insights from a lab at Columbia University on cell death, and spent a couple years there. And it was a great experience to learn sort of from day one, working with the venture firm that was seeding the company and also all of the other early employees at the company to really think about the strategy and, how to build things up from scratch. And that involved like unpacking boxes in a lab to sort of thinking about what our business development strategy would be. And so moving over to investing was a big change, but it's been really exciting. And to just give you a sort of high level overview on Polaris Partners, we've been around for about 30 years now. Our focus is in healthcare broadly. So that means probably 50% of our fund is kind of traditional biotech, so therapeutics. The other 50% is in kind of healthcare and biotech adjacent things. So healthcare services, healthcare tech, digital, a little diagnostics or med device. But most of my time is spent on the therapeutic side. And we're early stage investors. So we will invest in seed stage companies, so university spinouts, as well as Series A. And we always invest in platform technologies. So we rarely look at kind of single asset companies.
Thank you, Alexandra. And well, we're going to discuss about these early stage companies and investment and various of trend. And we also want to engage the audience, for many of them are investors and also from the industry. So let's start that by doing a survey question to our audience please send in your vote. What earns a university spin-out a second investor meeting? Maybe Alexandra, you can share your insight on this and comment on various aspects of this.
Yeah, very interesting. I mean, of course, the answer has to be all of the above in a way. I tried to vote, but it didn't let me vote. I would have voted for the team. But I'll start by saying that it is different for different investors what they really focus on. So I think all of these are important things that can garner you a next investor meeting. I think at Polaris and my own orientation is sort of being investors in a team. We work a lot with the same people over and over again, and it's really about building that relationship and investing in people. And we feel like that's actually the most sustainable form of investing. But I think all of these are important. So team, certainly important. It's great to have a team that is energized, it's nice if they've done it before, but that can't always be the case. We're always looking for the next generation of entrepreneurs, willing to learn. But I think it's the passion that sort of can't be taught. I'll also say a lot of the companies that we invest in, the entrepreneurial team actually doesn't join the company. They stay sort of in their labs at university, and they'll often serve. Sometimes they'll take a board role. Oftentimes they'll be like chair of the SAB. But we like the entrepreneurs we work with to be involved in the company, not necessarily in an operational sense, but in like a very involved advisory sense. And we see that as really critical to the success of the technology. I would put as my like second most important as customer need, which I'll reframe as unmet need. I think as long as you are doing something that can help patients in an issue that is not currently being addressed, you can build something that will be valuable. So that for me is the second most important. Scalable technology, I think it's important, but the scale part of it, I think, can come with development. I don't necessarily think that showing scalability at the outset is the most important thing, as long as you can show A, the potential to scale, and B, you know how to hire somebody who knows how to scale. So I think that's something that can come slightly later in the development of the company, but you need to have a line of sight for how to get there. And then a de-risking plan is, I would reframe this as a plan to maximize opportunity. In venture, everything is a risk. So, de-risking is a little bit of a misnomer. You want to maximize opportunity and you want to be able to recognize what the risks are. But I think it's a mistake in mindset to think about de-risking when you are inherently doing something that is risky.
Yeah.
So that's sort of my commentary on how I would classify those.
Yeah, couldn't agree more. I think this is a great way to start that conversation between investors and the team, and so because these are all very early stage companies, and they're obviously looking for fundings, and there's certainly investors and government. Can you maybe comment for these early stage companies and what's the funding strategy between the government sources and institution investors, and what the strategy they should consider in that?
Yeah, it's an interesting question because, we often see a mix of, government funding and venture funding, but usually the government funding is more focused on kind of the academic financing. And so once the decision to spin out is made, it's more focused on the venture funding. I would recommend, I always think it's great, especially actually throughout the life cycle of the company, for CEOs and founders to be scrappy about, finding funding that can help support their endeavors. There are times in the market when money is easy. This is not one of those times. And unfortunately, that's true both on the government funding side and on the private funding side. So I think being sort of as scrappy as possible about finding ways to fund what you want to do is super important, regardless of whether it's government or private. What I will say is you have to be careful about sort of taking money to do very specific things because you don't want to spread yourself too thin. And so some money comes with, very specific milestones attached. So you don't want to just take it and be like, okay, we'll do this, and then we'll also do this, and we'll do this. You still have to be thoughtful about, is this money actually going to help you get to the inflection points that you've kind of already defined as what's building value for the company?
All right. Great. So many new companies, when they raise money, they particularly like to ask the question, what's the current trend in investment, right? Maybe can you share some insight about that? What's the current trend? And also for companies, what should they do? Should they follow the trend? Or how that to best leverage that with their own strategy? Yeah.
Yeah, it's a good question. So I'll name a couple trends right now. So, okay, one is obviously AI, like AI this, AI that. People are applying AI for all sorts of things. Another one is there's a lot of activity right now in autoimmune disease or inflammatory diseases. So there's been kind of a shift from, well, definitely a shift from immuno-oncology, but maybe oncology broadly over to I&I. Obviously, there's a lot of stuff going on in the metabolism and obesity space. And then another trend is using sort of very, very validated targets, but throwing new modalities at validated targets. So like ADCs, radio ligand therapies, in vivo CAR T even. So it's really, the risk is in the build of the modality, and then the target itself is very clinically validated. I have feelings about all of these. We've invested sort of, in all of these different categories. What I would say about trends generally. So if we take the last one I mentioned, which is sort of the very validated targets, new modality. One of the challenges of only focusing in that is I think we're all aware that there are a lot of targets out there that have not been addressed yet. So, I personally feel that we still do have a need for new targets and to just
Mhm.
try different ways to hit the same targets over and over and over again. It's
Mhm.
going to work in certain instances. It's already working in some, but I don't think it's going to solve all diseases for us. And so
Mhm.
I think, funding needs to be spread to new targets as well, and people need to
Mhm.
still be comfortable taking some level of biology
Mhm.
risk.
Mhm.
The other thing I'll mention is that a lot of this type of work is being done in the China ecosystem. And as we've all
Mhm.
heard many times, in China, a lot of things can be developed much more efficiently and at lower cost. And so I do think if you're going after a clinically validated target and maybe a new modality, but one that's, partially been
Mhm.
commoditized,
Mhm.
you do have to, I mean, I think it's realistic to think, can somebody in China just do this for a fraction of the time and cost? And
Mhm.
is that ultimately what I'm going to be competing against? And I think the US ecosystem will thrive more on focusing on novelty rather than sort of, the validated portion of things. So that's one thought on the trend. I
Mhm.
think it's important for companies to be aware of what investors are excited about.
Mhm.
At the same time, everybody's aware of what investors are excited about. And so, the number of
Yeah.
I&I companies, the number of companies I've seen looking to get into atopic dermatitis or something, in the last like 2 months is astounding. And,
Mhm.
for us, all of a sudden it starts to be like, this is a lot of noise. And
Mhm.
then it's hard to really differentiate yourself. So it
Mhm.
really is a balance of being aware
Mhm.
of the trends and knowing like pharma is looking for this. This is an acquisition or business development
Mhm.
opportunity. The most
Mhm.
important thing is if you have a technology, is that you are using that technology for what it is best suited to be used for.
Mhm.
So trying to apply a tech to something just because it's
Mhm.
trendy or you think that will help raise financing, I think that is ultimately a mistake.
Yeah. Yeah. I hope the people who are presenting today take that into their heart to help them to stand above others in those advices. And we want to thank Alexandra for her spotlight speech, and she will stay for some of the sessions, listen to some of the presentations. All right. Thank you, Alexandra. Yeah.
Thank you so much.